All right, Natalia, thank you very much for being with us. It's a pleasure to have you. Thank you for accepting our invitation. And we are on the almost in the end of the course. So tomorrow is going to be our last day. And today we've traveled to some countries up to this point. We talked about the US, we talked about China, we talked about some countries in Europe and Europe in general, and to do some adoption monitoring and see and try to figure out which way will this thing go and how this all play out. And I think definitely one important thing that we need to look at is our neighbors. So today we have the pleasure to take a very close look to the Colombian experience, and which is a very interesting experience because one, you are an early adopter, and second, you are a Latin American developing country just like us, but you have an adoption history that is different than ours because we did adopt a QDMTT, or at least enough care was taken for it to be qualified. And I understand that Colombia went in a different direction and adopted ADMT. And so it'll be interesting to see how that experience went, what was the reasoning behind adopting a DMT. If you think not having a qualified QDMTT, will that hurt you or not? I mean, there's no safe harbor. It's placed differently in the formula. So SBII plays a different role on DMTs and QDMTTs. So it'll be interesting to know the adoption process, the policy behind. We have at least debated in some points in this course that Brazil might have jumped the gun, especially after the Trump statements and everything, if we did adopt too early. So it will be interesting to have a debate and to have a closer look into an adoption case study that is not ours and do a comparative analysis. So I'm very much looking forward for our talk today. And again, thank you very much from the bottom of our hearts for you taking the time to come and talk to us.
If you allow me just to mention, for those who don't know that Natalia, well, not only one of the most known lawyers in Colombia, but I think that Natalia has played a very strong role in international tax law, also in IFA. Just to mention to you whom you are talking to, Natalia is to be the very first female president of IFA. So, Natalia, of course, we invited you to understand about Colombia, what Colombia has been doing, because Colombia is this kind of weird situation because it's an OECD member, despite being in South America, and of course, there's some let's say it's interesting to understand Colombia's position. But also, since Natalia has this environment in IFA and so on, I'm sure Natalia has been hearing a lot. So, Natalia, we would be very glad if you would share with us some secrets. Of course, the secrets which are on the YouTube, but they are secrets anyway. So, whatever you want to say, thank you very much, Natalia, for being here.
Well, thank you so much, Luis. I am always very happy to be teaching in Brazil. I always say that the Brazilian students are the brightest ones that I've ever taught, and I teach in many places. So I'm very happy to be here, and please feel free to interrupt and participate. I really like the lively style of Brazilians that have questions all the time. So feel free. The idea is to share a bit of a very peculiar experience. The Colombian minimum tax is definitely a rare animal, and it is definitely not an adoption of Pillar 2. And this is the official Colombian position as well. Like Gustavo said, and thank you so much also, Gustavo, for having me. The Colombians chose actively not to qualify the tax as a QDMTT. You know, every country was sent a format by the OECD, and they all had to fill it out in order to appear in this guidance issued by the OECD on which taxes were qualified or not. Colombia simply ignored the format. They threw it to the garbage and went on with their own thing. And now with all the Trump developments, I think they're kind of happy that they went this way. But well, let's see what exactly it was that they chose to do. And for that purpose, I'm going to share my screen. Please let me know if you can see the screen.
We can see it, but the slide is not on full screen. So
yeah, it's taken some time to go full screen. It's turning around like a little rainbow. For some reason it's slow today. Can you see it now?
There you go. Yeah, now it is.
Good.
Perfect.
Can you see it going to the second one?
Yes.
Okay. So you have my email address right there in the title slide in case you have any questions about the Colombian tax. There's lots of bilateral investment between Colombia and Brazil. It might be useful if you ever have clients investing in Colombia or Colombian clients trying to expand to Brazil. This is certainly something that needs to be taken into account in the equation. The Colombian minimum tax is a domestic measure. It was adopted in a domestic tax reform, that's Law 2277, passed in August 2022. This is more than 2 years ago, and definitely earlier than the model rules were issued by the OECD. And here it's important to mention that Colombia signed the October 21st statement with the OECD. To remember this statement where they said that there would be 2 pillars and that all countries signing agreed to implement Pillar 1 through the MLC and Pillar 2 through the GLOBE rules that would be developed. So Colombia initially agreed with Pillar 2. And in spite of that, in 2022, they decided to do something a bit different to what was being discussed at the OECD. So I think the inspiration was very similar. We are, in August 2022, we had our first leftist president, Gustavo Petro. Colombia had never elected someone from the left. We're a very right-winged country traditionally. And this was the first time that we had a leftist government. And the first act of government was to introduce the tax reform in Congress. This was the first thing they did next day after government took office, after the president took office. And the president promised then, and this is a political window that you see in the slide in the bottom part, he promised that he would only pass one tax reform. And this tax reform had a very narrow political window because he knew, I think, that Congress would turn against him eventually. So he took advantage of the majorities and passed this reform the first day he took office. And what he was inspired on is this global political trend that the OECD tried to spread, saying that tax competition needed a floor. So this was the actual political discourse that was sold to Congress. You know, we are creating a floor to taxation so that everyone who has the ability to pay will pay at least 15%. And it seemed again like a noble cause, especially, you know, in countries that are so unequal as ours. If there's very large companies or very large taxpayers that don't pay much, people are very unhappy about that result. So promising people that everyone would pay at least a 15% was a very leftist, you know, kind of rhetoric that was sold back then when we passed this reform. Also, being an OECD member, we realized that we were among the top countries with the highest tax rates as in the OECD. our corporate tax rate is 35%. And then some industries like oil, coal have a surtax of 2%. So the nominal tax rate is 37% in some cases and 35 in the others. And the average rate in the OECD is just 23%. So we're a high tax country.
Natalia,
Yeah.
just for comparison, just make sure. And you have the 35% and you do tax dividends.
Yes.
Okay, just to know, because we have 34%, but dividends are exempt, just for students to compare.
Yeah, well, we have a very complex calculation of when to tax dividends, and this is very relevant. We will see it later on for the effects of this tax in the calculation of profits that can be distributed as tax-free dividends. So we do have a tax on dividends, but it doesn't apply to profits that paid at the corporate level.
At what rate the dividend tax?
So it depends on who the recipient is. The general rate is 15%, and then we have a lower rate for some special recipients, with like natural individuals, which is 9%. But then if it's for public companies, then it can go down to 7%. And then it also depends on the years that your profit was obtained, because we used to be like you before. We didn't tax dividends until 2017. It's relatively recent. So profits obtained before 2017 are completely free of dividend taxation, but then after that, there was a transitional regime, and nowadays it's 15% in average. So very high rates. That's the conclusion. So our politicians said, well, it's not a bad idea to have a floor to tax competition, given the fact that we're losing that competition because we're one of the top taxing countries, right? So why not stop the countries that are going down in their rates? So this is why Colombia remained committed to the globe rules and to the globe discussions. And this is the rationale that they gave Congress when they introduced this tax. They said this is really a floor to taxation. And then there was a big debate already in 2022 about how this Pillar 2 would affect countries with tax benefits. And Colombia grants lots of tax benefits. However, the technical argument given by the ministry back then is that we didn't really have accurate measurements of whether those benefits were working. So we would only keep those benefits that we knew were working. And when we study how the tax is calculated, you will see that they included some benefits in the calculations, but not others. For
Natalia,
example, yeah.
sorry, just to correct me, I remember when I was in Colombia that I learned that several benefits you offered, for instance, for hotels and so on, have a very long term and you could not change them. So, I mean, I understood that you were in a kind of trap with the tax benefits.
Yeah, we granted a 0% rate for 20 years for new hotels, and this is included in the calculation of this tax. And then also we used to grant legal stability agreements. There's still several companies who have a legal stability agreement. Most of those agreements will be over in the early 2030s. But we still have many companies. Those agreements were granted for 20 years also. So the ones that got the stability agreement.
Natalia, that's why, sorry, because the students don't know the Colombian system and these kind of peculiarities. I think that they enrich a lot debates. So Colombia offered incentives for 20 years, and these stability agreements, meaning that once you get this, whatever the law changes for everybody except for those who are signatories of these agreements. So that means when you talk about the 35%, okay, 35%, but some companies are not paying that. But it is not a tax incentive, it's stability. Simply to say, once you accepted to invest in this environment, this would be kept. So sorry, Natalia, to explain this because I think this is important for the students to understand what's your situation there.
It
I
is
have
very
a follow-up
important.
on
Yes, Gustav?
just a follow-up on that. First, was there a study of the ETR, the average ETR, at least for Colombian companies before adopting the DMT? And was that more taken into account than the OECD trend? Meaning, were they worried about, well, we have a low ATR and these benefits cannot sustain anymore, so let's do a DMT? Or it was basically, well, we don't know what's going on, and let's just import this international trend of capping tax competition, and by chance we might hit our incentives. That was one. And second, if you have stability agreements, do they take precedence even on the DMT, or the DMT kept the ETR even for those with stability agreements? Because that's relevant to know the effect.
Okay, so for your first question, which is a very good question, Gustavo, we did have lots of estimates produced by the different associations. So the Association of Oil Companies had their own average ETR. Then the general, commercial companies, the Andy had a very general ETR for, corporate taxpayers in Colombia. And then there were other associations like mining that had a very high ETR. But in all cases, the ETR was very high. It was always above 30%. And then in the case of the extractive industries, it could go up to 60% because of very special taxes that they had, including the surtax that I was talking about. So the motivation was not, we are having a very low ETR. It was just, there's this trend in the world. Why don't we seize the moment and also follow this trend and create a floor for those who might not be paying? But the stats actually pointed to everybody paying very high rates. So that was not the motivation. And then for the legal stability agreements, that's a very funny case because initially Colombia didn't think of the legal stability agreements. And then they received a notice. I don't know if you've ever dealt with international arbitration for tax cases, but the procedure is you first warn the government that you have an intention to file a lawsuit. So you don't directly file, you first file a warning. So they received a warning that a lawsuit would be filed under an investment treaty.
But those were for situations covered by investment treaties, right? By bilateral investment treaties.
Yeah. But this was a taxpayer with a legal stability agreement who said, if you don't exclude taxpayers with legal stability agreements, we will sue you under this treaty. So Colombia ran and changed it was still in the tax reform when this was happening. It was still being discussed in Congress. So they had to run and convince a congressman to introduce the modification to the rule. It was not proposed by government, but by Congress, that they kept an exclusion for those holding a legal stability agreement. And the rationale for that is the calculations of the arbitration fees were much higher than the revenue that they would obtain from most of these taxpayers. So they were very scared about the arbitration lawsuits, and this is why they chose to protect taxpayers with legal stability agreements. So this is the context, where Colombia said, okay, I'm ready to go for this trend. And I only have this narrow window because the president had promised I will not do another tax reform in my period. And, the experts warned them, they told the government, we are members of the OECD. There's no model rules. If you do your own thing, it might not match what the OECD does later. They said, it doesn't matter. We'll do something more general so that in any case, we'll be faithful to the objective of creating a floor for everyone. And that is exactly what they did. So they created this TTD, that's for the Spanish name, Tasa de Tributación Depurada is the technical name of this tax. It's actually called a tasa, not a tax. It's a levy, not a proper tax according to the title. And it covers all corporate taxpayers residing in Colombia. So this is the first complaint that most people have, you know. The OECD was very clear in establishing thresholds, and the thresholds were actually very high, you know, 750 million euro turnover is a turnover that's not very common in Colombia. So it would only be, I don't know, around 20 to 30 companies that would be subject to this, that were Colombian-born companies. However, when this tax was approved, it forgot about the thresholds, which had been already announced. You know, this was not in the model rules. This was in the October agreement for the globe. They had already said, you know, this is a measure that we will apply to the very big ones, who we believe are the ones that are able to transfer their profits more easily. And Colombian government said, you know, we don't care. We want this to apply to everybody. So there's a general rule saying that it applies to every corporate taxpayer who's a resident of Colombia. No threshold for income or net wealth. But there is an exclusion if your effective tax rate, if your tasa de tributación depurada is less than 0, then no. It's not the effective tax rate. I'm sorry, I need to fix this slide. If your taxable profit is less than 0, then the company doesn't have to calculate this tax. So you still, even if you think you're a loss-making company, you still have to make an initial calculation of the taxable profit, and only if it's under 0, and this is tax, not financial, then you can stop calculating.
So I may have a book profit, but if I have a 0 negative taxable profit, I don't need to apply the rule.
Yeah.
Which is weird also, because, you know, depending on the incentive, I might have big book profits and 0 taxable profit, right?
Yeah, but that's the thing. In the calculation, which we will see next here, it's very complicated, but in the calculations, they excluded most of the tax benefits. So in the end, you know, you would remove that from the numerator as well. So you wouldn't have a negative, you know, it's very unlikely that you have a financial profit and not a tax profit. But it is possible that you have a financial loss and a tax profit, and are still made to calculate this top-up tax.
Natalia,
Yes.
just a question. Do you have participation exemption for investments abroad?
No.
Okay.
We have a special regime for holding companies, which we will also see in the next slide why it's relevant. But it's a very specific regime. It's not a general participation exemption. You have to file to be a Colombian holding company and be in that regime. So this tax is applicable to taxpayers in free trade zones, which was also very scandalous back then, because free trade zones were offered a 10% rate, nominal rate. So with this tax, they had to raise the nominal rate to 15%, and then everyone, including free trade zone taxpayers, would be covered. Then they excluded a number of taxpayers, which you see here includes the hotels that Luis was talking about. But then if you're big enough, even if you're a hotel, you still have to apply this rule. And the big enough has to do with the requirement to file a country-by-country report. Now that you've adopted the OECD standards, you should be familiar with the country-by-country filing. This one does have threshold of the approximate 750 million euro. So if you are a hotel, you are excluded, but if you're a hotel whose turnover exceeds 750 million euro annually, then you still have to calculate this minimum tax. The taxpayers that were excluded were the very small ones that go for the simple regime. The profits, the maximum profits that you can obtain under this simple regime are like $50,000 in a year. So these are very small taxpayers. The special social economic zones, which were granted a 0% also for a long term, I think 10 years. And this is for areas that were hit by natural disasters, like the islands of San Andres and Providencia. They had a hurricane and they were fully destroyed. So if you invested there, you would have a 0% rate for a long term. So if you're one of those, you're excluded. Then there was also the ZOMAC. These are the investments on war-affected zones. So the municipalities that were affected by the armed conflict in Colombia, if you are exclusively operating there, then you are also exempt from calculating this rate. We have the hotels that Luis mentioned, editorial houses, and there's also a debate here because most editorial houses will publish not just books, but also magazines and other types of contents. And the courts say that, and the tax administration say that this is only applicable for editorial houses that only publish books. So what houses are doing now, editorials are doing now, is they're segmenting their financial statements so that at least they can exclude the income from the book business. And there's still a debate whether they can exclude that because apparently under the tax administration's interpretation, if you also publish a magazine, then you're doomed and you have to include all of your income. So let's see what the courts say in the end, but there's a debate there. The other companies that were excluded have to do with government. So Ecopetrol, for example, the government-owned oil company, or fully public companies are excluded, like the energy company, it's also public. And then public-private alliances and concessions for infrastructure are also excluded. So if you're a joint venture for building a road, the joint venture itself will not be made to calculate this tax. And then foreign residents. So this part here is favorable to the Trump developments, you know, because American companies that don't own a fully established subsidiary are not required to calculate this tax. So Trump's rationale that they're discriminating against American companies cannot be applied for this tax. Does anybody have a question about the scope of this tax? So we excluded many of the beneficiaries of what the government called proven tax incentives. And then we included everybody else.
So Natalia, just to make it clear, for foreign residents, if I invest in Colombia through a PE, I'm gonna probably be taxed as a PE there, but I won't be subject to the minimum tax. But if I do invest through a subsidiary, then I will be subject to the minimum tax. Is that correct?
Well, no, you would have to create a PE. Well, PEs would also be taxed because PEs are considered corporate taxpayers in Colombia. But then if you don't,
without PEs.
Yeah, if you don't meet the threshold for the PE, and that's super easy nowadays for example, fintech companies. We have lots of companies coming from the US that don't really meet the PE threshold. And those are household names, you know. Netflix has no PE in Colombia. Amazon now has a PE, but they didn't have one before. Airbnb has no PE. Those types of digital companies do not meet the threshold for a PE, and they would not be forced to calculate this tax because they would be considered foreign residents.
But they are also not subject to the corporate income tax in that sense, right?
Well, they're subject to the significant economic presence rule because we adopted a different standard for those companies. So they have to create a special tax identification number, but they are not considered residents. So they are taxpayers, they have a tax ID, they have to pay on their significant economic presence income, but they're not considered full corporate residents.
Gotcha.
Yeah, it's complicated. Sorry, guys. Colombian
No,
rules
no,
have become
it's very clear.
more and more complicated every day. So this is the interesting and very complicated part. How do you calculate this 15% minimum tax? So we also adopted the rate that was adopted globally, the 15%. And this 15% was the minimum tax, the minimum rate that every taxpayer in Colombia has to demonstrate as of 2023. So this tax has been operating 2 years already, fiscal year 23 and fiscal year 24. So what you first have to do is calculate your profit. That's the denominator here, the utilidad depurada. So to get to the depurated profit, you start with financial accounting profits. And there was a huge debate there on the use of the International Accounting Standard 12. I don't know if anybody knows that standard, but that standard says that profits can be negative or positive. So if you have a negative profit under IAS 12, you still have a profit to start with. So there was a big debate there, right, for negative financial profits. So you see that's the accounting profit can be positive or negative under the rules. Then you have to add permanent differences. And here the government was very emphatic. They only included permanent differences and not the temporal differences. And this is one of the main reasons why this tax will never be qualified as a QDMTC. And there was no rational, technical, or political that was ever officially stated by the government on why they chose to exclude the temporal differences. They just went ahead and said, we're only taking into account permanent differences. And what do we mean by permanent differences? You must know now because you've had several productive aulas on this topic. So permanent differences are mostly non-deductible costs. For example, taxes, for example, fines, and those types of things would be permanent differences that you would have to add to your accounting profit, right? And then once you get to the profit with the permanent differences, that would be like the fiscal or tax profit, then you start subtracting the excluded incomes, the income from equity participation, the capital gains, because our capital gains tax is separate from the income tax, and this is supposed to be part of the income tax, and then the exempt income. And here in the exempt income, this is the RE, rentas exentas, they only included very specific income. We have rentas exentas, we have exempt income in 1,000 different laws dating from 1939, 1970s. I don't know if that's the same for Brazil, but they're not all contained in the tax code. Every time someone issues a law, they try to issue some tax benefit for whatever it is they're approving. So a new law for books comes with a tax incentive. A new law for bringing technology to the rural areas comes with a tax incentive. And then they don't compilate those in the tax code, right? So the only ones that they allowed are exempt income from treaties. The holding company regime, Luis, you were asking if we had the full participation exemption, and what we have is the Colombian holding companies, the CHCs. and income from free housing. So there's a specific tax benefit that that says that income from building or selling free housing, well, free or low income housing is exempt. But there were many other benefits for clean energy, for new technologies, for R&D that were not included in this exempt income little box. And then finally, you subtract any carryover losses that you bring from prior years in the income tax. So that's how you get to your depurated profit. And this calculation, which you see is extremely complex, has to be done by everybody. Because as we saw here, if your depurated profit is below zero, then that's the only way you can get out of it, right? So everybody, even loss-making companies, have to calculate this UD. And then you have two options. If your UD is greater than zero, then you continue with the whole process. If your depurated profit is equal or less than zero, then you're excluded from any further obligation under this regime. Then you go to calculate the numerator, which is the depurated tax, the impuesto depurado. This one's easier. You just take the net income tax, and the net income tax is just a line in your corporate income tax return, and there's a specific number. They tell you, you know, this number corresponds to box 98 in your corporate income tax. So it's there's no discussion on what this is. And then you have to add the tax discounts, because this box number 98 already includes has already subtracted the tax discounts from treaties or the unilateral relief of double taxation. So then you add it up to the net tax. And then you subtract, we have a CFC regime. I think Brazil also has one. If you have passive income abroad and you have to tax it, then you have to include that tax in this calculation here. So the complex part in arriving to the depurated tax is the CFC regime, because there's lots of discussions over the CFC regime. For example, if you have a trust in the middle of the corporate chain, does it break the minimum ownership rules, and do you still have to calculate that? If you have rental income, is that considered passive or active? And it depends on the bylaws of the company. There's lots of details that are very tricky in the CFC regime, but you have to know that number in order to arrive to this numerator. And then once you have the total tax and the total profit, then you divide them and you obtain this TTD, the ETR or actual tax rate. If this is below 15%, then you have to calculate a top-up tax. The top-up tax in Colombia is called the Impuesto Adicional, IA, and you just multiply your taxable profit by 15% and then subtract the taxes that you've already paid. And then that's how you calculate your top-up tax. In the case of consolidated financial statements...
Natalia, just to confirm, there is no exclusion for substance-based, I mean, for substance. It's
no, the exclusions are the ones we mentioned here. So operating in special economic zones hit by natural disasters, hotels, operating in war-ridden zones, producing books, being public, and then here we have the exempt income, which is treaty income and free housing. That's all. So our substance is very narrow. It's not everything that could create jobs or infrastructure. It's free housing, books. public infrastructure treaties, and like I said, there's so many more that were just not included, like the clean energies, like the new technologies, like the R&D. Those are not included here. As you may imagine, and we will see this later on, there's lots of constitutional lawsuits against this arbitrary inclusion of some exempt regimes and not others. And the only argument that the government gave is that these are proven benefits that actually work. But the others, we don't know if the impact is good or not, and that's why they say they excluded the others. Then we have to calculate this total TTD for consolidated groups as well. And there's another lawsuit in the Constitutional Court for that, because the intention of the legislator was, well, you can't transfer profits amongst a national domestic group to be able to comply with the minimum 15% everywhere. So if you have one entity taxed at 30 something and another one taxed at 10, then you can combine those in the consolidated statements and move things around, and then you would be exempt even though there's one entity in your group that is paying less than what we want you to pay. But then the tax is calculated in the consolidating entity, and the consolidating entity can be paying an effective tax of 30 something, and you still have to pay a top-up tax for any sub-entity that is not paying the minimum 15%. So there's also a constitutionality lawsuit there, but it has already been resolved against the taxpayer. So this is the calculation. As you can see, it's similar to the OECD, but with very important differences. It's similar in structure, but has very important different details. First is they exclude temporal differences. Second is they only include some exempt income in the calculations, but not all. Third, you are obliged to calculate this even if you're a loss-making entity. And fourth, you have a very different regime for consolidating groups and companies that don't consolidate, even if they are in a group, but they don't meet the thresholds for consolidation. What are the effects of this tax? And these effects are important. There's one first effect with the dividend withholding. This is what Luis asked at the beginning. Do we tax dividends? Yes, we do, if they are not taxed in the corporate level. But this top-up tax is added to the tax at the corporate level. So then there's a strategic move. When you choose to pay an additional tax, you can get tax-free dividends. So some people are actually paying this top-up tax voluntarily so that they can get tax-free dividends out. And then some others didn't see this effect. And what they did is avoiding, that in general, accountants are recommending clients in Colombia to avoid the top-up tax. So what they do is they reject some costs as non-deductible so that they that the UD will be less, and then you won't have a top-up tax. But for those cases, those clients who are being recommended by the accountants, they won't get tax-free dividends. They will have to pay when they issue the dividends. So that's only useful if your company is not distributing. If your company is a distributing company, you better pay the top-up tax. Then there's another effect, that's the carry forward. Usually with the general income tax, if you're paying excess tax, you can carry that forward for 5 years. With this tax, you can't. And the tax administration has said that this is a period-specific tax. You have to pay 15% every single taxable period, so you can't carry over to the next periods. It also has an effect on the down payment for next year's tax. I don't know if you have that in Brazil, where you have to calculate how much tax you will pay next year, and you have to pay a down payment on that. No?
We do have to pay along the year. So we have to anticipate based on estimated profits, but we don't do a down payment of a future tax.
So in our tax return, you get the tax for this year, and then you have to pay an additional tax, which is an anticipation for next year's tax. And how you calculate that is based on what you've paid already. So you have to add this additional tax. So your down payment will be larger if you have to pay the IA. So in cash flow, sometimes it's also wise not to pay the IA and to reject some costs that would be deductible otherwise. If you are going to have to pay a lot of down payment because of that. So it depends. Then another effect is that this tax includes unrealized gains, and this has to do with the temporal differences. In your accounting profits, you have, for example, income from foreign exchange variations. And I don't know if this ever happened to Brazil, but in Colombia, we lost 40% of the value of the peso since the pandemic, 40%. So you have 40% unrealized gains if you have any investment in currencies other than pesos. And that's taxed under this minimum tax, which is absurd because it's completely unrealized and, well, it's illogical, but that's the way they have it. And it's the same also for appreciation of investments. So if you have a loan in USDs, you may have a loss, like a tax loss because of the exchange rate. But if you have assets or investments in USD, then you have an unrealized gain that is being taxed. And there's another constitutional lawsuit because of this pending in the Constitutional Court. Let's see what they say. There's the issue of loss-making companies, and this one has been partially resolved. There was a lawsuit not in the Constitutional Court, but in the Council of State. And what we said is this violates the ability to pay principle because loss-making companies don't really have ability to pay a top-up tax. So what the Council of State said so far, they don't have a final ruling yet, but they suspended the tax administration ruling that interpreted that you would still have to calculate the tax because of the International Accounting Standard number 12 that allows for a negative accounting profit. So this is suspended in December. So the bad news for people is that those who had to calculate it in 2023 had to pay an additional tax, even if they were loss making. But the ones that made a loss in 2024 were okay. They didn't have to calculate because of this ruling that we obtained in 2024. Then the other very important effect that Gustavo was mentioning at the beginning has to do with the QDMTT. So most developing countries have chosen to adopt a QDMTT. The big debate is, about when, but most agree that they should implement well, they did before Trump. Most agreed that a QDMTT would be the way to go. However, Colombia took a very different direction, and they chose to maintain this tax. They had an opportunity for an additional reform. You know how governments promise something and they never really fulfill those promises. So there was an attempt at a tax reform this year. And one of the first things that the private sector asked is, please fix this minimum tax and make it in accordance with the model rules, because now we do have model rules. So it's your opportunity. And then the government said, no, we're very happy with the way it is. we're not having a QDMTT. But the private sector said, well, if you don't have that, then you're forcing companies to calculate Pillar 2 on top of this. And government said, sure, and that's fantastic. So we are not very competitive under this government, and it's a nightmare for companies that have to calculate both this TTD with the very exotic calculations that we just saw, and on top of that, you have to do Pillar 2, and this TTD will be combined with the regular income tax as a covered tax, is what the OECD has said so far. So it's just a covered tax. It's as if you had paid, you add this one plus the income tax, and that's your income covered tax. But yeah, not very competitive, not very investor friendly, but that's what the government decided. And then the last thing that I wanted to share with you about this tax has to do with the constitutionality and legality. There's some reflections on this that are ongoing, and some others have been resolved already because we have this tax for 2 years already. So out of the different constitutionality lawsuits, there's been one ruling. It's ruling 488 of 2024. It was issued in October last year. No, actually in November, end of November in 2024. And what the court said was very disappointing. They said that the legislator had enough autonomy to determine the way they wanted to define the income tax. So if they wanted to do an income tax for loss-making entities, there was nothing in the Constitution to stop them. So go ahead and design a tax, even if for loss-making entities. For us, this is terrible because there is a principle in our Constitution that's called the ability to pay. And they completely sub-valorated this principle vis-a-vis the freedom that the legislator should have to obtain their own revenue. They also considered that this doesn't violate the ability to pay because it doesn't violate the minimum vitalis, which was very weird. I also must clarify that there's never been a tax expert in our constitutional court. None of the judges are experts in tax. They have never been, and sometimes they make this kind of mistakes, you know. For us in tax, the minimum vitalis is applicable to individuals, not so much to companies. But for them, this was the standard that was applied. So if the company can still have a vida digna, that's like a decent livelihood, then it's okay. It doesn't violate the ability to pay principle. So if you're a loss-making company and you're forced to pay the additional tax, then according to the Constitutional Court, that's okay if you can still make a decent living as a corporation. Then the court also said that there are 2 tests that the tax passes. First one is the proportionality test. So what they said is if the legislator wants to combat tax evasion and tax avoidance, then the measure is quite adequate for that end, and that is a permitted end for the state to pursue. So then if the measure is adequate, then that is enough to pass the proportionality test. If it means that you go out of business because of this, it doesn't matter. It's still worth it because combating tax evasion and tax avoidance, it's worth it. And the same rationale happened with the integrated equality test. They also applied the light form because the end of combating tax evasion and tax avoidance was a legitimate end, and therefore they only had to evaluate the adequacy of the measure to pursue that end. So they decided that this tax complies with the integrated equality test. So it's a disappointing but still interesting ruling, and you have the link here. I will send them the PowerPoint so that you can read it. It's in Spanish, but it's a very easy read for you.
Natalia, just one question here about the legislation I didn't ask. Is there a minimum size of the company which is subject to this? I mean, or every Colombian company is subject to it? I forgot it.
No, no threshold. There's
Uh-huh.
only an exclusion for the companies qualifying for the simple regime. And the
Okay.
simple regime is a maximum profit in the
And
year of 50,000.
just to
It's very,
compare just to compare, a pure Colombian company with
yes,
no affiliate abroad will also be subject to this tax.
yes.
Okay.
What's the threshold for the simple regime?
You cannot have profits over $50,000 in a year.
Per year?
50.
Oh, that's super low per year.
That's super low. That's like hairdressers, bakers, very small businesses. Yeah. And then the question, the legality question was solved more satisfactorily. But we don't yet have a final ruling. We only have the temporary suspension of the loss-making ruling that I was telling you about. So this was the Council of State, and it's funny because the ability to pay principal is a constitutional principle, but it was the Council of State who said that this ruling violated the ability to pay principal for loss-making companies. So for 2024, because this was a ruling notified in October 2024. So for companies that made losses in 2024, they will not have to calculate the top-up tax, even if their theoretical utilidad depurada tax profit would be above zero, which made the tax administration very angry, but it was pretty obvious. And thank God the Council of State was able to see it, unlike the Constitutional Court, who went and analyzed the minimum vitalis, which was something very unrelated to the whole question. The ruling that has the temporary suspension of those tax administration interpretations is also linked here in the slide, and you can also see it. It's also always fun to see how it plays out in courts now that we've already had 2 years of experience with this tax. So you can also draw some arguments from those rulings for your own constitutionality analysis when the Brazilian tax is submitted to courts. So I think this was all that I wanted to share with you on the Colombian measure. It's a very relevant measure. It is enforceable for 2 years now, and Colombia has just refused to comply with the OECD standard, and they have just decided and chosen to create this floor for everybody, including domestic companies like Luis was asking. So I don't know if anybody has questions, comments, outraging remarks. Michelle?
Michelle has a question online, but just wrapping it up. So you enacted the rule not really knowing who you're wanting to get for like following an international trend or a fad, but when the trend became reality and there was, well, this and this and this and that you need to follow to qualify to the whole thing, you said, no, I don't want to be on the trend anymore. And
I like what I did better. It's what Colombia said, I'm getting more revenue, so why would I go for that? Yeah.
Understood. There was a promise of the government not to change until 2026, so it would not be able to do it also. That's also this issue or not?
No, they didn't fulfill that promise, Luis. They introduced a new reform this year, but it was defeated in Congress. So they did have the opportunity. They had the legislative opportunity, and they were asked to do this. And they very bluntly said, we're getting all the revenue we want. Why would we change it? Yeah.
Good. Michelle.
We were just one thing. We were having a class with Professor Tsui and discussing his paper. And on his paper, his argument is that governments are usually income maximizing, not revenue maximizing, but the country income maximizing. And if you're income maximizer, and his line of reasoning is perfect, you wouldn't adopt either an IRR or a QDMTT or a UTPR, and for a whole different reasons. But the problem is that, well, at least Latin American governments are not necessarily thinking of income maximization. They are sometimes thinking about revenue maximization, and sometimes they're not even thinking. So we can we can surely see that this kind of adoption doesn't follow income maximization, because it can drive away investments, it can hamper competition of local companies, and sometimes not even revenue maximization, because from what you said, they didn't even do a revenue study or something saying, well, we have too much of a low ETR, and let's get some money and get away with these incentives. Michelle, I see you raised your hand, so please.
Thank you, Gustavo. Thank you, Professor, for your insightful presentation. At the end, the Colombian legislator did not provide for a global rule. It is a different minimum tax rule. And from your presentation, I get that there are very diverse constitutionality problems arising from this specific rule. And I quote for your presentation: the text passed the proportionality test in slides in slide form piercing tax evasion and avoidance. And I'm not sure if the globe rules have the same purpose as we discussed in previous lessons, if the globe rules are based on tax evasion and tax avoidance, or it's just minimum tax. I would like to hear your thoughts on this position. What are the purpose of the globe minimum tax, and if the globe rule as it is would receive the same ruling from the Constitutional Court of Colombia. Thank you.
So thank you, Michelle, for your question. In the case of Colombia, the purpose pursued by the legislator is always a domestic purpose. So even if the OECD has 1, 2, 3, or 5 different purposes, if the law that adopts the OECD standard mentions the purpose of combating tax avoidance and evasion, then that's the purpose that the Constitutional Court will take, because that was the Colombian legislator's purpose, independently of what the OECD would say. And this, I think, is a tiny bit of resistance that we still have towards being an OECD member. There's still many members of Congress that hate the OECD and hate being imposed with international standards that they never discussed. And the courts also think that there's this, sovereignty that should prevail over what the technocrats do at the OECD. So in the end, our courts don't really pay that much attention to what the OECD says in terms of purpose. It's what the government and the Congress say in terms of purpose. So I don't know if your Brazilian rule has the mention of the need to combat tax evasion and avoidance. I think that's become sort of a mantra for all tax reforms in our continent. And if that's the case, then you might have a similar reaction from your court saying, we don't really care about what the OECD was thinking about. What we really care is what you, the Brazilian Congress and Brazilian government, were thinking about. And then the tests in the light form, it's also, we have this terrible precedent from 2016 that decided that for tax purposes, you only have to adopt the light form of the test if the tax measure is pursuing a legitimate purpose, like combating tax avoidance and evasion. So now every time we have a tax reform, there's always a mention of the purpose to combat tax evasion and avoidance, so that they will always get the light version of the constitutionality test.
Well, now Paula wants to speak.
So thank you, Professor Natalia, for your presentation. It was very insightful. I remember maybe a couple of years ago, you did another presentation in one of the IBGT congresses, and you mentioned that by joining the OECD, you were subject to new transfer pricing rules, and they were quite hard to enforce from tax authorities' perspective, and it was becoming all the sort of complexity that it was difficult to address. So I was wondering, since you have the rule for 2 years now, although it's not as complex as the globe rules, especially because there are no temporary differences, which add a very significant layer of complexity. How do you see the enforceability of these rules in Colombia? For example, taking in comparison transfer pricing enforceability, how courts deal with this kind of complexity. We can see that not very well, but I wonder in a tax case, how this would appear, and if you think tax authorities on the ground can deal with this kind of calculations and etc. Thank you.
Thank you for that question. It's a very relevant question, and I think it's still a challenge as it was 2 years ago. You know, our people are definitely not trained in the business. And whenever you go to tax rules that require some knowledge of the business, then it is always very, very difficult to audit this kind of rules. So for example, in the insurance business, you have lots of deductible tax reserves that could be considered permanent differences. But then there's been some audits where the tax inspectors think that it's a temporary difference, and that, you know, it would be optional for the company to make those reserves, and those reserves are regulatory because you're an insurance company. So while our auditors have no knowledge of the business, we will still have lots of challenges in the auditing. You know, they keep encountering difficulties, and there's other, you know, simpler cases where they still have difficulties. For example, horizontal property. I don't know if you have this in Brazil, but here, buildings and condos are taxpayers themselves. And calculating this for a building or a condo is hard because, you know, the contributions made for the administration fees by the residents are not necessarily taxable income. And there's no special rule in this depuration thing for these taxpayers. So we've received some audits over buildings and condos that just make no sense. So we still have that challenge, unfortunately.
Question. Big opportunity. That's why I'm asking you, inviting you to. Yes, please, Mariana.
Hi, Natalia. Thanks for your presentation. At the beginning, you mentioned a bit international arbitration, and I was thinking about mutual agreement procedures. Do you think we can expect some kind of relief when dealing with a MAP procedure between Brazil and Colombia? Do you have arbitration clauses for it? Because I think in Brazil we don't.
Yeah, when I referred to arbitration, Mariana, I was referring to investment arbitration, because Colombia has a lot of investment treaties, both bilateral and multilateral, with the Pacific Alliance and other groups of countries. So the analysis that they made back then was, if there is any kind of legal certainty that's being violated by the introduction of this rule, then there might be an argument for a violation of the fair and equitable treatment clause in those treaties. So the standard for legal stability agreements under the fair and equitable treatment clause was that the legal stability agreement is the provided certainty that was offered by the government. So if they violated that certainty by introducing a tax that would supersede the legal stability agreement or any agreed form of certainty, then the government would have to pay very high penalties for the investors under exit arbitration, most likely. So just calculating arbitrator fees, lawyer fees, witness fees, we would have to call on Shreddy to be an expert witness. All of that was just too expensive for the government, so they chose to amend the rule while it was being discussed in Congress because of this. But it was not under double taxation agreements that you would get arbitration. And obviously, this has an impact on DTAs, on double taxation agreements. But as you saw in the slides, there was an exempt income that you would always subtract whenever there was a DTA. So when our treaty with Brazil comes into force, which hasn't yet happened because we're still in the constitutional procedure to ratify, when it comes into force, any income that is exempt because of the treaty will have to be subtracted from the UD under the rentas exentas, the RE box. So I hope we won't need a map. It's contemplated in the rule.
Yeah. Okay, thank you.
Very good. Further questions? Observations? I don't see any movement here, Natalia. Gustavo?
Yeah, just an afterthought. First, I think Schroeder's fees was the tipping point, right? When they gave up dealing the arbitrations. We in Brazil, we don't have investor country arbitration. We do have 3 bilateral investment treaties in force, and none of them have investor country arbitration. So that's very out of our scope. But we had Blazes speaking with us a couple of days ago regarding the bids and Pillar 2, and definitely for those who have them superseding tax benefits conceded, especially with a time period, might be a very, very, very sensitive issue under FAT on those treaties. Natalia, just as an afterthought, and for us to get out here with some perspective. And now, as Shuari said, not only talking about Colombia, but speaking to you with your whole position with IFA and so on and so forth. What is your view on the future of Pillar 2? And we know, we have Trump now, we have those possible tariffs or countermeasures, and probably we'll see some extension of the UTPR safe harbor and UTPR not being applied in the near future. So what are your thoughts regarding UTPR, countries that do adopt the IRR, and what countries that adopted the QDMTT, which way should they go, or a DMT or whatever? Should they stick with it? Should they repeal it? I have my view, but I wanted to listen to you regarding this.
Well, I think the general consensus in the international community is that both pillars are dead after Trump's executive orders issued in January. I think, well, Pillar 1 was already dead. He just, I think, put the nail on the coffin. But for Pillar 2, he definitely made it very hard for Pillar 2 to become what everyone thought would become of Pillar 2. So there's lots of countries that took the position of wait and see. In our continent, most countries took the very conservative position. And you can see it in the PT-LAC, the countries were all demanding for policy courses on Pillar 2 last year. This year, they've asked to change the topic, that they're no longer interested. You know, ministries are no longer interested in receiving any training on Pillar 2 because they do see it as something not worth their while. It is likely that governments will still try to implement domestic measures to increase revenue. I mean, we really are very hungry for revenues, and seeing the costs of climate change, and you had the Porto Alegre disaster last year. You know how expensive it is to recover from something like that. All governments want to have more money to be able to react to these kinds of things, which will be more frequent going forward. So I think there is an appetite for new unilateral measures, but probably not in the form of QDMTTs, IIRs, and globe rules. Pillar 1, I think, is definitely dead. And I think what most countries are thinking is, how can we draft a measure that will not be deemed as discriminatory to the US companies? And this is something that we can contribute to. You know, all the Colombian measures are very general and non-discriminatory in nature. Our significant economic presence rule, which is our substitute for Pillar 1, was evaluated by a Congress committee in the US in Washington. And they had the conclusion that it wasn't discriminating against US companies. It was just bad for everybody. So they didn't think that they would be able to impose any trade sanction against Colombia for the SEP. So I think there's a shift towards significant economic presence in the space of Pillar 1. And I think there is a shift towards more broad measures, like the ones that Colombia very crazily and hastily adopted in the space of Pillar 2. But again, I think this was never something driven by the Global South. The way Pillar 2 was born was as a compensation for the rights that would be given under Pillar 1. That's why it was a whole package. I don't know if you remember when it was being sold that way. It was sold as, if we give Pillar 1 to developing countries and market economies, then we will have to give Pillar 2 to the Europeans. And it was France and Germany who drafted most of the model rules. It's more a European thing. So I don't think, I think definitely that Trump removed all the momentum that Pillar 2 was gathering. And I think the Global South is rethinking how to address this space. And I think, broader measures like the Colombian measure that also applies to domestic companies might be an unfortunate inspiration to other Global South countries. Let's see. I think we will see lots of movement this year and the next. And then, there's also the UN. We will be discussing protocol and services. And from what I gather, the significant economic presence is the standard that they are trying to push for in that protocol. So we may have at least a multilateral agreement on how to treat those Pillar 1 profits. And there's no agreement yet on what to do about Pillar 2, but there might be a space also at the UN to discuss how to move forward in that space. Let's see.
This UN space. Now, even this is something which you begin to discuss. What can UN do now? I mean,
so the UN approved the creation of an intergovernmental committee. This was a resolution passed by the General Assembly in December. The Intergovernmental Committee has already had a first organizational session in February.
And
Brazil,
was there a US representative there?
yes, and they stood up from the table and said they wouldn't want to continue negotiating in this space, which I think was celebrated by everybody in the UN, because they came to the UN space assuming that the US would never participate in any solution. I mean, it would be the fourth time that they dictate the terms and don't sign. And I don't think countries are that dumb. You know, we accepted it 3 times. There was, you know, the exchange of information, then there was the MLI, then there was the Pillar 1. Those were 3 times already. I think for this fourth time, everybody knew that the US would never sign, even if they were sitting at the table. So when they were honest and transparent and said, you know, we want to stand up, people actually, the Global South actually held a party in New York, because now they weren't able to water down the measures that the Global South is wanting to put forward. So now what they interpret the US leaving the table as is there's no change in the outcome, because they still would not sign any solution that would come out from there. But there is a huge benefit in process, because you won't have a delegate saying, no, this has to be changed, the comma should not go there, but there, to make it less friendly for American companies. So now they can go after what they wanted to go after without the US being a block on the road. So you know, in the end, even though they thought, I think politically it would weaken the process, people are actually feeling freer and happier without the US sitting there. And I think the Brazilians were in that party. Ricardo.
I do believe this. Any further question? Observation. Natalia, I don't see any movement here and also no movement from the screen. So unless Gustavo has something different to say, from my side, I would say only thank you so much for being with us. It's a pity it's only online, because I adore when you come, you know, in person, because it's nice to have you. But anyway, thank you for cooperating with USP once again.
I love being here. Thank you so very much for bearing with me in this topic. Is sometimes not as fun as other topics. So thank you so much for putting up with the presentation on the calculations and everything. But I hope the messages were clear, and I hope to see you in person soon.
Natalia, it was very clear, and it really provided what we were looking for. So thank you very much for participating and for contributing. It was really valuable.
Okay. Bye, everyone.
Bye-bye.
Ciao, boa tarde.
Ciao.